David Burrows has told us he's keen on consumer stocks in developed markets. So his first pass pick, and this dates back to January of 2015, Starbucks stock did split 2 for 1. And so factoring that into account, total return of about 35%.
Yeah, I'd buy the stock today. You've got 4% wage growth in the U.S. 20 states have raised minimum wage. You've got consumer confidence. It was better in January than it was in December. The consumer is fine. The ISM Services Index was at 55%, meaning getting better, not worse. Manufacturing's weak. So I think I want to continue to focus on the consumer. And Starbucks has a great franchise, lots of opportunity to grow globally. Great company.
Okay, so let's talk about Walt Disney. This one flat, because of course the ESPN, there's fears that they could lose a lot of revenue now that people are paying directly for that sports channel.
That's right. So certainly Disney had a very good run up into the launch of Star Wars. And there are some concerns about, in the near term, about ESPN. This is a stock that we've ultimately exited. But we like some of the media space. You just have to see whether Disney can get it turned around with ESPN.
But generally, I mean, Disney, for longer, is it a stock you could hold forever?
It's a stock you could own for a long time. In the near term, it's getting hurt with the recent pullback in the market. You know, it's really only been better than 55% of stocks over the last year. The stock got to $120 before pulling back to 94. So we're fortunate to sell at higher prices. But in the near term, you know, there are lots of questions around media companies because of Netflix and because of the streaming businesses. The question is, where will things go from here?
So that would give you a pause with the
media. That would give
media.
me some pause in the very near term, yeah.
Okay. And then American Tower, this one down around 9%. Can you remind us what they do?
So American Tower is a real estate investment trust that owns cell towers really around the world. And so ultimately what they're doing is they're leasing space to mobile phone operators to put their gear on the towers.
Okay.
So it's like a hotel for electronic gear. And you can put a lot of gear on a tower without adding a lot of new expense. So it's they've had very, very good cash flow growth. REITs have been a little bit of a tougher space over the last year. I'm not sure that I would buy the stock, but I would certainly keep it on the list for one to buy if markets start to get turned around.
And just on cell phones generally, are you still a buyer of the telecoms in Canada?
Well, look, you know, the reality is there's not very many places to go in Canada right now. And I think that part of the strength in companies like BCE, for instance, or relative strength, have been because of just a lack of investment targets in the Canadian market. So I think that there's better places to look, frankly, than in Canada right now. You know, Canada's likely has a rate of change that's getting worse, and the U.S. is improving. So I would prefer to focus investments in the U.S. right now than I would in Canada.
And what about cell companies, telecom companies worldwide?
You know, it's not a leading neighborhood within the market. It's getting more and more competitive
and maturing.
And mature. And so I'm not saying that in the future they can't do okay, but given the current market behavior, I would be looking in other sectors.
Yeah, so we've seen this revolution, a mobile revolution, hundreds of millions of people really connected to the global economy now with their cell phones.
That's
but
right.
Presumably the rate of adoption is going to slow in years to come.
Well, and you know, competition for data rates and so on is going to continue to get tougher.
Yeah, because eventually everything gets commoditized, doesn't it?
That's right. So this whole space is a little bit tougher, and there's some good dividend yields. You know, we were big investors in TELUS for a long, long time. And I just think that, you know, while they're doing better relative to the market because they have a more predictable income stream, nice dividend, I would prefer to look for something that's going to win from a tailwind naturally occurring through some changes that are taking place in the economy. And consumer healthcare would be another space that we'd be looking at, and technology would be another space.
And TELUS, of course, a major competitor of our own parent company, BCE. Is TELUS going to be under a cloud until we find out how successful Shaw will be in mobile phones? I
think that you know, we need to see how that all comes out. And I'm not saying, again, I'm not saying you're going to do poorly owning BCE and TELUS. They're good companies. If you're buying them for the yield, you're going to do just fine. You're not going to get hurt with a slowing Canadian economy. There's a lot of people that have to be in the Canadian market. There just might be more productive places over the next 24 months.
Okay. David, we're going to be back with you after the break. Remember, you can get in touch with David Burrows right now. Give us a call, 1-855-326-6266.